Welcome back to Yahoo Finance Live, everyone. Markets have certainly been on a roller coaster this year, and with that comes some tough decisions for investors. Joining us now to discuss the risks of trying to time the market is Jordan Jackson, J.P. Morgan Asset Management Global Market Strategist. Jordan, great to have you here with us this morning. The difficulty of timing the market, I mean, you would essentially need a crystal ball or just go out play the lottery after you do time it correctly, if so. But if you are timing opportunities right now, where would you believe that those opportunities are to be found right now?
Sure. So the first point I want to make is that you highlighted, right? It's really about the market, not timing the market. Just to sort of emphasize that point, right? The worst day in the year this year was April 29th. Markets down 3.6%. 5 days later, on May 4th, was followed by the best day ever, where markets were up 3%. Now, to be honest, I don't know if I would have had the mental fortitude to get back in the market after a bad day like April 29th. And so that's why it's really important for not trying to time the market in this sort of environment. But what I will say, where we're still finding opportunities, right? We still think recession risks are fairly low. So we still are thinking that, there's some value still in some of the more value-oriented parts of the market, sectors like industrials, maybe another leg higher in financials, materials as well. And so some of these more cyclical value-oriented names, we still think have another leg to run here. But I will say, I think it's an environment in which you rent value and own growth, right? I still think in the second half of this year, inflation is going to start to come down, growth is going to start to moderate, and investors are going to be willing to pay up for that growth premium, particularly given valuations have come down pretty meaningfully on the growth side of things.
So in other words, value for the short term, growth for the longer term. Am I interpreting that right?
That's a fair assessment. I think even while growth might stop shine in the sort of second half of this year, as we move into next year, we still think value is cyclical value may have another leg higher in the short term.
Jordan, I understand. I appreciate you probably can't talk specific stocks, but look, when you have a Walmart out here this morning, an ugly earnings miss, have a conference call where they warn about changing consumer patterns and consumers potentially slowing down and trading down to cheaper goods. Doesn't that raise a red flag on the chance of a potential recession and get you wondering if you should get more defensive with your portfolio?
Well, I think it means you certainly get up in quality within the portfolio. And yes, that means a degree of defensive names as well. But I think that an important thing is looking at companies that have high degrees of operating leverage in this environment. They've got good purchasing power. They can maintain their margins in an environment where you have higher input costs and higher wages. And so, again, it's really about having up in quality within client portfolios as we're, very much sort of late cycle. And again, those recession risks really starting to bubble up as we look towards next year and into 2024.
But what is this report as well, and even looking across Walmart, Home Depot, what does that kind of foretell about the status of the consumer, especially even as we were digesting the retail sales data earlier today, and whether or not they are actually flush with cash, as we had heard earlier this year, where some of that cash may be dwindling and the savings may be dwindling at this point in time, and what that foretells perhaps going into the summer where we know that that's a higher consumption season, higher traveling as well.
I certainly don't want to sort of throw away the retail sales report, but we've got to remind ourselves that the retail sales is in big box retailers like Walmart and Home Depot. These are very much goods-orientated businesses, right? Retail sales is very heavily focused on the goods side of things. But what we're seeing now is that spending is shifting from goods to services. It's getting back on flights. It's going back out to restaurants. It's finally checking back into some hotels and enjoying some vacation. And so that's where we're seeing the spending really begin to shift. And so looking at the retail sales, I think there are some good sort of nuggets there in terms of the health of the consumer. But I'm really focused in on how spending on the more services-oriented parts of the economy as those businesses are opening back up and this sort of pent-up demand to get back out there and travel again, I think is going to be the real sign of the health of the everyday consumer.
Jordan Jackson, J.P. Morgan Asset Management Global Market Strategist. Always good to see you. We'll talk to you soon.